Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
Well, it feels good to be back. Let me turn that up a little bit. I don't even know if you heard me. That's how long it's been. I can't even work my own board here. It's been that long. Welcome, everyone, to the second edition of Wilmington Mortgage. I'm the aforementioned host of this podcast, Tyler Crawley, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina, and it was a pretty good Monday. First of all, it felt like fall, like winter, actually. It was cold. It's going to be cold tonight. But yeah, I mean, it was like 78 this weekend. Did not feel like fall. Now it feels like winter. We didn't even get fall. We went from one season to the next. But it feels good for another reason, and that is the government shutdown could be coming to an end, which means economic data is back. I'm so excited. I mean, it's been a month. We've had some like scattered reports. We did get that weird kind of CPI report, but it's been a while. And I don't like it. I like a world where we get economic data. Here's some other good news, though, before we get into everything. So the first podcast I did about a week ago, I've been wanting to do this podcast for a while. I said, let's just do it. I'm going to try and do it once a day. If I miss a day, it's what happens. But that's sort of my goal. So I did the show, and I just like posted it. I didn't even promote it. I just was like, I got to do a show. You know, they always say like the best thing when you want to do something, just do it. So I just did it, and I posted the show on my RSS feed in one of the podcast feeds, and I didn't like promote it at all, and I still got like 30 downloads, which I don't even know how people found it. In all honesty, I'm kind of amazed that people found the podcast without me literally doing anything. So I'm now even more excited about this venture going forward, but it is Wilmington Mortgage. That's the name of the podcast. The whole purpose of this is to talk about what is happening with mortgage rates right here in Wilmington. Of course, mostly national stories. We're all going off the same kind of book. What happens in, national data impacts mortgage rates. It's not like we got mortgage rates for every individual place, but I really care about Wilmington because that's where we are. And so we had rates jump today, almost 3 basis points. So we are now at 4.12%. And let's see, let me look at this chart. So we did jump last week to like the highest level since September. So we're down from that a little bit, but we're still up from under 4%, which is where we were just a few weeks ago. So why did rates rise? Why did we see a jump in rates? So first of all, the government shutdown is obviously probably the biggest reason why. So we did hear this weekend from Kevin Hassett, the White House chief economic advisor, who said that the government shutdown could actually end up having a negative impact on the economy if it were to continue, that we could see a negative print for the fourth quarter because of this shutdown. I mean, obviously it didn't affect, I would say, most people's lives, but it was starting to kind of filter through the economy. So like, obviously, if you're a government employee, you've been directly affected for now, was it 41 days, directly impacted. But there are people who are then, ancillary businesses. So that would be people who are relying on government workers to, come into their restaurant or come into their store or whatever. And government workers don't have money, so they're getting impacted, which then impacts. And so kind of like, what do they call it? They ripple in the pond. It's sort of making its way through the economy. And that's sort of what Hassett was arguing. And so the fact that we're now going to possibly get out of this shutdown, that's a good thing for the economy. So that's why you're going to see stock market jump. And so people are going to get out of bonds and go back into the market. And so you're going to see people sell off bonds, which is why you are seeing rates rise. And so I guess kind of let's start there because, government shutdown coming to a close. After 40 days on Sunday night, we saw 8 Senate. Well, they weren't actually Democrats. I think Angus King was one of the votes who's actually technically an independent. He caucuses it's like Bernie Sanders. Like, where's the independency? It's like, I know he doesn't want to be a Democrat, but they vote with the Democrats. So it was 8 members of the Senate who caucused with the Democrats is basically what it was. They broke ranks, joined the Republicans to advance a stopgap bill that would reopen the government through January 30th. Now, Punchbowl News reported that the package, which was paired with 3 bill minibuses. So, you have the omnibus bill. So I guess if you have smaller ones, they're called minibuses. Instead of omnibus, you have a minibus. There were 3 were included in there, as well as language reversing the mass firings of federal employees carried out during the shutdown and blocks any additional layoffs through the end of January. And then also was a commitment from Senate Majority Leader John Thune to hold a vote by mid-December on the expiring Affordable Care Act subsidies, which was the argument for why the shutdown was happening to begin with, is that the Democrats wanted a vote on these subsidies, and they used this sort of shutdown to kind of get the Republicans to agree to that. Or I should say not necessarily a vote, but then the hopes that it would obviously carry is sort of what they wanted. And now what they have is a promise to have a vote, which it should be noted, and Punchbowl did note this. This is something that Thune has been floating almost since the shutdown started. So it's not like this was a concession or anything. This is exactly what he was asking for. So we're hopefully going to move forward. Now, Riley Beggin and Theodoric, is that his name? Theodoric Meyer? I kind of like that name, Theodoric, of the Washington Post noted that any senator can slow the process. Because if you had 100 who all voted to just push this forward, it would happen. But without that 100, unanimous vote, anyone could kind of slow things down. Not like a filibuster thing, but just, slow things down. And so it could take a little longer to get through the final passage. So that could happen, midweek, probably later this week. Once the Senate finishes, the deal heads back across the Capitol, goes to the House because there have been some changes. So the House vote, you can't just say, oh, the House voted for a bill and the Senate voted for a bill. They have to vote on the same bill. And so now this is going to go back to the House. And I believe that Mike Johnson has said that once that final vote starts, he's going to demand everyone come back to Washington. Originally, I think he was going to give them 48 hours. Now we're down to about 36 hours. So I guess it's possible that we could see maybe the shutdown end this week, but more than likely, I would guess next week was when we'll probably officially be out of it. So it could happen this weekend, but I would be hard pressed if we were able to get this all done by Friday. So, but it is looking like it's going to happen. I've heard a lot of Democrats aren't happy. But it looks like that's not going to stop anyone, and this is going to move forward. And so we are going to end the longest shutdown in U.S. history. We're at 41 days, so we will see. I doubt we'll get to 50, but we'll probably clear 45. So we'll see where it goes. So like I said, that's good for the economy, good for pretty much everyone. So the government's going to reopen, and I'm really excited because I'm going to get economic data again. It's been rough looking at these kind of minor reports and trying to figure out what matters and piece things together. It has been kind of fun though, looking at some of these kind of B-level reports that normally we wouldn't talk about. And all of a sudden we were talking about them and I was like, maybe we should look at these more often. Maybe there's some value to these posts or these reports. So, I'm excited to start actually getting data back, jobs report, inflation data, all that fun stuff. So I'm very excited about that. So good things moving forward as what day is it? It's the 10th as we move through November. So November's looking up. November is looking up. So that's obviously the big story of the day. No doubt about that. That's really what was moving rates. Nothing else really happening. No major reports. We are going to get some kind of minor reports once again later this week, but really all eyes are going to be on will the Senate and House be able to get these things passed. And I'm feeling good. I think, like I said, I think we're not going to get to 50 days, but I think we probably will get over 45. No doubt about that. So we will see what happens. Now, there was a big story. This would not impact rates. I don't think it would. But there was a big story over the weekend that everyone's sort of talking about. I've gotten a couple people asking me about this. And that was President Donald Trump on Saturday floated the idea of a 50-year mortgage. So he posted on True Social. It was an image of FDR and him. And over FDR's photo, well, first it said, what was it? Great American presidents. And then over FDR's photo, it was 30-year mortgage. And then over Trump, it said 50-year mortgage. And so everyone was like, he's hinting at a 50-year mortgage product. And not long after that, Bill Pulte, director of the Federal Housing and Finance Agency, confirmed this idea by saying, quote, thanks to President Trump, we are indeed working on the 50-year mortgage, a complete game changer. That's what he wrote on X, formerly known as Twitter. Now, this, of course, started an interesting debate on whether or not we should have a 50-year mortgage. Now, I did want to give a quick history lesson, just because that's always important. So FDR did oversee a lot with housing. Housing wasn't obviously responsible for the 29 crash, but the crash did create some massive problems with housing. And it was really part of his administration was about making it easier for people to get into homes. So under his watch, we saw the creation of Fannie Mae. We saw the creation of the Federal Housing Authority or Agency, And so these were all things that were being done. And I think at the time they had about a 15-year mortgage, I think is what the FHA initially was a part of, and created that loan product and backed it to give, some confidence to this new marketplace. But ironically, the 30-year mortgage did not come about until Congress authorized it in 1948 for new construction, and existing homes it wasn't allowed until 1954. So Roosevelt died in 45. So I did think it was a little funny that, once again, FDR and a lot of what he was doing, what was happening with the government was about helping to secure people in homes. No doubt about that. The creation of some of these sort of products out there. And like I said, the 15-year I think was big then, but the 30-year did not get authorized until 1948. That was not when FDR was president. Just pointing that out. Now, a lot of people were pointing out the 50-year mortgage is a joke on its face. It's the dumbest thing ever. And I don't think that. I mean, you can think that, but I went and looked at this because I wanted to see if I was right about this. So from the Social Security Administration, life expectancy for a man born in 1948 was 64.8 years. All right. Today, the average lifespan for a U.S. male is about 76.1 years. So what we've seen is the lifespan for an average male, when the mortgage came out for a 30-year mortgage, has increased by about 12 years. And so, if you think about it, if you're someone back then, you bought a house, you're 25 years old, 30-year mortgage, you're 55 when you pay it off. You get about 9 years with it till you die, according to this numbers. Was that numbers right? Yeah, that was right. Yeah, about 9 years. So if you're looking at, let's say, a 25-year-old buying a home, you pay it off in 30 years, 55, you'd get over 20 years with that house. So obviously, if we were okay with someone only getting 9 years in 1948, only getting 9 years now, you could offer a larger timeline on a loan product. So I don't think it's like super crazy. Like I think 20 years might be a little much, maybe 40-year product, something along those lines. Do we need to do that? I don't know. But like I said, it's not ridiculous that we would have a mortgage loan product with a longer term on the loan when we were doing 30-year products when the average lifespan was like 64. And so now that it's 76, like I said, maybe not a 50-year mortgage, but a 40-year would actually be kind of in line with what we were doing in 1948. So on its face, a lot of people were making fun of the 50. Oh my God, can you imagine paying, a mortgage for 50 years? Well, I mean, that was sort of equivalent to paying a 30-year mortgage in 1948. I mean, you were looking at a loan product that was almost half the lifespan of somebody. Now, of course, now that it's 76, once again, half of that 50 is over that half. So you'd be paying it for more than half of your life. But like I said, a 40-year, there's some equivalency there. That's all I'm trying to say. Now, here's why I don't think it really makes a ton of sense. Now, first of all, most mortgages pay off in about 7 to 10 years. You either pay them off or you refi or you sell your house, get a new one. So that's the average lifespan for a mortgage. Now, that number is probably going to increase because of all the people who locked in with crazy low rates during COVID. They're never getting rid of that mortgage. They might move out of the house. They might do whatever. They'll just end up renting the house out. But they are going to hold that mortgage for the life of the mortgage, for the most part, because that is basically free money that they're still benefiting from. They might do, a HELOC or something along those lines. But a lot of people, unless they are forced to, are going to hold on to those loans. So you're more than likely we're going to see that 7 to 10 number rise because of how beneficial it will be for people to hold on to those crazy, crazy low rates. But 7 to 10 years is sort of what was the norm. So, 30, 50, whatever that. But see, here's the problem. So it's when you break down the numbers. So if you ever looked at like your mortgage statement, so the first couple years of your mortgage is when a lot of your money is going to interest. You're not paying off a ton of principal. As you get further down the line, you're paying more and more and more are going to principal. So if you extend the life of that loan, that means in the early years, people are paying less and less of their principal. So when they do end up deciding that they are going to sell their house, they're going to have less equity with a 50-year than with a 30-year. And when you look at the actual savings of this, it's not that great. Now, I don't know what it was like back in 1948 when we had the 15-year and the 30-year. But as of right now, if you look at a 15-year and a 30-year, you're looking at probably 50 basis points. I think that's what I saw from Mortgage News Daily today, about 50 basis point difference. So if you're looking at a 6.22% 30-year fixed, you were looking at a 5.72 15-year mortgage. So because of that, if we go to a 50-year product, you have to assume, let's just assume the same increase, even though that's a bigger increase, 15 years versus 20 years. Let's assume that if you decide that you're going to do a 50-year mortgage, you're going to have a higher rate. So now instead of 6.22, you're looking at 6.72. So when you break the numbers down, not to get too boring, but a $500,000 loan, a 30-year mortgage at 6.22% carries a monthly payment, that's just principal and interest, P&I, of $3,069. Over the full 30 years, a borrower would spend about $1.1 million, meaning about $600,000 in interest. So they're going to pay $1.1 million for a house. Now that'll probably be worth $1.1 million based on appreciation in housing if you look at sort of the historical average. Now a 50-year mortgage would almost certainly have a higher rate, like I said. So let's say you're looking at a 6.94% mortgage. That would drop the monthly payment only slightly to $2,978. So you'd be saving just under $100 a month. However, over the life of the loan, the borrower would pay $1.78 million for that house with a staggering $1.2 million in interest alone. So you get a slight reduction in your monthly payment, but man, you're paying a lot more in interest. I mean, that's just kind of how the numbers work out. And so, I just don't feel like that's a big enough monthly savings to really have an impact on the industry. $91. I mean, sure, there are people out there that would maybe be able to qualify that wouldn't qualify, but I mean, I feel like that's just not enough. I mean, that's actually math I didn't do, so I'm going to do it right now. Keeping a calculator on my phone. So let's see, 3,000. What's the, $3,069. So $91 divided by 3,069. It's just under 3%. So you're saving 3%. I feel like there's another way that you could do that that would maybe be more beneficial than extending the loan product by 20 years. So once again, I don't think on its face it's a horrible idea. As I said, if you go back 1948, average lifespan 64, 30-year mortgage, just under half that. Maybe we're not there for a 50-year, maybe a 40-year, with the average lifespan about 74 now, 76. But so the people that are just automatically laughing at it saying, oh, this is so dumb, can you imagine? It's not that ridiculous from where we were when the 30-year mortgage came out. My only point is that if people are looking at this like this is going to be revolutionary, it's going to get all these new borrowers into the market. It's not. $91, sure. Beneficial, 3% say is just not. If we were talking about a 50% reduction in payment, oh yeah, that's an entirely different story. If they were able to do something that would lower someone's payment that would be $3,000 to $1,500, yeah, huge difference. $100 on a $3,000 mortgage. I mean, that's just not. What is that doing? Some people, sure, but sort of having a massed impact, I don't see it. So, like I said, not ridiculous on its face, but it's more in the numbers. And you're like, what's this really going to do? We'd be much better off, like I said, the one thing we could do right now, I mean, obviously Trump can't do this, but the one thing that would tremendously help the mortgage market would be to get that historical spread from the 10-year and the 30-year back to the historical average. Historical average is 175 basis points. Right now, I think we're at like 220. So if we could get back to 175, that'd be a 50 basis point reduction. We'd be seeing mortgage rates at under 6 right now. Yeah, I mean, we'd be at, 175. Yeah, we'd be at 5.8 for a 30-year. So if they can figure out how to do that, that would be way better and more impactful than a 50-year mortgage. All right, I think that's it. I think we got to everything. I kind of a busy Monday, so I didn't really have a ton to get to everything else, but I think we covered some big stories. 50-year mortgage, government shutdown coming to an end. I'm pretty excited about it. You guys enjoy the rest of your Monday. We'll be back here we'll see, Tuesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.